On July 19th, Tata Sons announced a plan to invest about $5.2 billion in a gigafactory in the UK. With an initial annual output of 40 gigawatt hours or GWH, it will be the first EV battery gigafactory by Tata outside India. Back home, the conglomerate has signed an agreement to build a $1.6 billion lithium-ion cell gigafactory in Gujarat. With Jaguar Land Rover and Tata Motors as the anchor customers, supplies from the proposed UK factory are expected to start in 2026. The new plant is likely to come up in Somerset, in southwest England, while JLR's plants are near Birmingham in central England. A British paper has reported that the UK government has offered Tata up to $642 million in subsidies for the plant. While the UK may cheer the development, a natural question is, why did Tata pick the island nation? The group does have major business interests in the UK. In 2007, Tata Steel acquired Chorus for £6.2 billion in what was one of the largest cross-border acquisitions in Indian corporate history. But the going has hardly been easy. The European operations comprise two primary steelmaking units, one in the Netherlands and the other at Port Talbot in Wales. It is the latter that has mostly been a struggle due to high cost of operations and structural issues. And now, some of its assets are coming to the end of their life. So, these would either have to be replaced or transitioned to a newer process that's environment friendly. Tata Steel has been in discussion with the UK government for support because cash flows of the business can't support such a transition. And while the UK government offered $386 million earlier this year, it was lower than the ask. In short, Tata's global forays and acquisitions have seen their share of challenges. As another example, in 2000, Tata beat the likes of Nestle to acquire Tetley Tea's worldwide business for £271 million. While this made Tata Tea the second biggest tea company in the world, the realization of the synergies that existed was delayed, and Tata Tea couldn't take the fight to Coca-Cola and PepsiCo as it had intended. Despite all of this, there may be two good reasons behind Tata's drive to the UK. UK-based JLR, which has been a wholly owned subsidiary of Tata Motors since 2008, accounted for nearly 70% of Tata Motors' $14 billion revenue during Q4 FY23. Moreover, JLR has embarked on an ambitious journey to become an electric-first luxury car maker by 2030 and announced a plan to invest $18.65 billion over the next 5 years to achieve its electric roadmap. The second one was highlighted by Tata itself, which said that the UK Gigafactory would deliver electric mobility and renewable energy storage solutions to not only customers in the UK, but also to those in Europe. According to Eurobat, the EU will account for 26% of the global battery market by 2030, up from 17% in 2020. And according to the Financial Times, under the UK's post-Brexit agreement with the EU, to gain tariff-free access, a car sold from one side to the other must have 55% of its content coming from within the UK or EU. For EVs, about 45% of the content must originate from the UK or EU from January 2024. For battery packs, 60% must originate from Europe or the UK for it to be considered local. Against this backdrop, the UK would look attractive if Tata wants to cater to JLR and Europe at the same time. But what do experts think about Tata setting up a battery plant in the UK?
If you look at the decision of Tata's to locate the battery plant both for stationary and mobile applications in the UK, is driven by multiple considerations. Post-Brexit, the whole trade between UK and EU is governed by a different set of regulations. And therefore, for the vehicles to be marketed in the EU, they have to have significant local content. And the battery is a significant part of the electric vehicle, and therefore locating the battery manufacturing in the UK enables them to actually gain access to the EU market going forward. Also, the stationary applications and all are developing quite rapidly in EU and in the UK. So it's a new market that is opening up for them.
On why one would choose UK as the location for the EV battery factory, it's a bit hard to understand from a business logic perspective, given Brexit, given the high costs in UK, and given that there is no real competence in the UK for production of electric batteries. However, it may be that the Tata Group, with its sprawling empire, has other issues, including the steel, where the government may have done an informal quid pro quo that they will help out with the steel operations if the battery operations were set up in the UK. But otherwise, on an objective basis, it's a bit hard to see, though of course I don't have any inside information.
While the experts disagree on the merits of the UK as the location for the plant, the plan is set to go ahead. As such, what challenges might it face?
Because of Brexit, the tariffs are going to change for import after 2024. UK currently does not have enough resources in terms of the natural resources to set up all these battery facilities. So definitely they will have to import a lot of raw materials from Europe and rest of the continent. And since the gigafactory will be finished only by the end of 2026, the new tariffs will already be in place. So in this case, the costs of raw materials are going to go up, and this will pose a challenge for Tata Motors.
Tata seems to have the advantage of captive buyers in JLR and Tata Motors, but it will have to overcome challenges arising in the wake of Brexit. On a separate note, whether the mega investment in the battery plant fast-tracks the grant of support for Tata Steel's UK operations remains to be seen.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.
She's working her way to the corner office. Business Standard.